So if everything goes right in retirement planning, a retiree can actually keep their tax bill as low as possible during retirement. Now to discuss some of the ways to develop an efficient tax plan is my guest, Scott Phillips with SDP Personalized Planning in Salt Lake City. Scott, can you talk about the difference between tax preparation and tax planning?
Yes, we believe that tax prep is reactive. You bring in your tax information to your CPA, accountant, or person filing your taxes. You give them the information, they file and prepare your taxes for state and federal. We believe planning is proactive. Proactive in that in advance of filing, the year previous to filing, you look at your tax situation, you look at your income, you look at your potential deductions, you look at ways to minimize your taxes on an ongoing basis proactively. That's once again coordinated with our team of professionals.
Scott, now talk about how the different retirement plans are actually taxed.
So in a retirement plan, typically you'll have tax-deferred qualified plans. Those will be 401ks or 457s or IRAs. They are tax-deferred, meaning that you make a contribution, you get a reduction of your income on your tax return. That is tax deferred. That when you take it out, you pay tax on those proceeds or that money that you deposited previously, plus any gains you'll be taxed on. Now, a Roth, your tax is tax-free, meaning that on the accumulation and when you take it out. When you make the contribution is not deductible currently. However, all of the accumulation, no matter how long that is held, once it's held for at least 5 years, none of that accumulation will be taxed to you or to your heirs, whether that be a spouse or to your children.
So one strategy to minimize taxes is Roth Conversion. How do you know if that's a good idea?
We've found that many people think that you're limited in the amount that you can do as a conversion. What a Roth Conversion says is that you can take an IRA, a 401k, and you can convert any amounts to a plan where you pay the tax when you take the money out currently, but all of the accumulation will be tax-free. So the amount that should be taken out, that's where a careful analysis needs to be of how much you might want to convert. We believe that everybody ought to look at how much they ought to convert because it may be to their benefit to take advantage of tax brackets and keep their taxes now. We believe that taxes, because of all of the stimulus packages that we've had, we believe that taxes will be going up in the future.
Finally, are there any other strategies a person should be aware of if they're already in retirement?
Yes, that's where you need to be proactive and looking at your current income or how your monies are allocated. You'll have pools of buckets of money. You'll have your taxable, which money you've already paid tax on. You'll have your tax deferred, which is your 401ks or your IRAs, and you'll have your tax-free. So we believe in tax allocation, meaning that you look at where you have money. What we find happening is most people have all of their money or a big majority of their money in tax deferred because they're thinking that tax rates are going to go down in the future. And that may not be the case. Tax rates may not go down in the future. So we believe in tax allocation and being proactive rather than waiting till you become required minimum distributions at age 72. You look at it in advance to make sure you minimize your taxes.
That's Scott Phillips in Salt Lake City, and this is Retirement News Online.